Dear students, in this video, I am going to explain a very important topic of financial accounting. Capital receipt is different from revenue receipt. The same question appeared in GNDU examination December 2018 also. So first start with capital receipts. So we can say capital receipts are those receipts which either create liability or reduce an asset. Creating liability means, for example, if we borrow loan rupees 10,000. So borrowings it's a capital receipt. Similarly, what reduce of an asset? For example, we sell an asset and whatever we received, this is a capital receipt. These are non-recurring in nature, and these are actually described as money brought to the business from non-operating sources. So examples of these receipts are like amount contributed as capital, money obtained by way of loan, proceeds of sale of any fixed asset or investment, amount realized from debtors or bills receivable. Now, what are the revenue receipts? Revenue receipts are the receipts which arise through the core business activities. These receipts are a part of normal business operations. They are recurring in nature and benefit can be enjoyed only in current accounting year. For example, sale proceeds of goods, sale of old newspapers or packing material, commission for services rendered, income on investment, discount received, rent received. So if we talk about the accounting treatment, revenue receipts are transferred to the credit side of trading and profit and loss account. Capital receipts, they are shown in balance sheet either as liabilities or as reduction in value of asset on asset side. Now, what are the guidelines for distinguishing the nature of the receipts? So while differentiating whether this is a capital receipt or revenue receipt, some basics are of much importance. First is the nature of receipt has to be decided from the point of view of the receiver and not payer. For example, when a company pays interest out of its capital, it's a revenue receipt for the shareholder or the person receiving it. So we have to focus on the person who is receiving it. Payment received for the sale of fixed asset is capital receipt. For example, plant and machinery, land and building, or furniture and fixtures previously not intended for resale. It's a capital receipt. The motive of owner of property is also material in deciding the nature of the receipt, particularly in a single transaction. For example, the receipt from sale of shares or debentures held as investment, it's a capital receipt. And if these securities are held for speculative purposes, the sale proceeds comprise a revenue receipt. A receipt in lieu of source of an income is treated as capital receipt. For example, compensation received on the death or permanently disability. Because such receipt is a substitution of source of income, this will be a capital receipt. On the contrary, if a person due to some injury is temporarily out of work and he is paid some compensation in substitution of his loss of income during the period of disablement, it's a revenue receipt. When an amount is received for the surrender of certain rights, it's a capital receipt. For example, compensation paid by an improvement trust for the acquisition of agricultural land for the construction of a road, it's a capital receipt, since it is in lieu of right to work on the farm. On the other hand, if the amount received is in the nature of compensation for loss of future profits, it is revenue receipt. So what are the basis of comparison between these two receipts? Capital receipts are the income generated from investment and finance activities, while the revenue from operating activities. Benefit of capital receipt can be enjoyed in more than 1 year, while in case of revenue receipt, it's enjoyed only in current year. Capital receipts are non-recurring in nature, revenue receipts are recurring in nature. Capital receipts can't be saved for creating reserve funds. Revenue receipts can be saved for creating reserve funds. Then capital receipts are not available for distribution of profits, while we can use revenue receipt for distribution of profits. Capital receipts are shown in balance sheet either as liability or as reduction in value of the asset, while the revenue receipts appear on the credit side of the profit and loss account of the year. Example for capital receipt is sale of fixed assets, and for revenue receipt it's a sale of goods of the business. Thank you.